Have you ever stopped to think about how businesses, big corporations or even smaller startups get their hands on essential stuff like machinery, vehicles, big office spaces? How do they do that without sinking huge amounts of cash up front? It's a big hurdle. And often the smart move involves something called a finance lease. Maybe not glamorous, but really important. So for this deep dive, we're really pulling back the curtain on the global finance lease market. And this isn't some tiny niche sector. Okay, it's huge, it's expanding fast, and it's changing how companies get and manage assets all over the world. Our mission today. To unpack the latest trends, look at some pretty surprising growth projections. We're talking 2021 right through to 2033 and see how different regions are playing their part.
Exactly. And we're digging into some really valuable insights from a recent, very detailed market research report. It's just packed with data. It tells us what this growth looks like, sure, but maybe more importantly, it helps us understand why it's all happening. Gives you a clear picture of this whole financial landscape and, how it impacts businesses, maybe even yours.
Okay, let's dive in then. The big picture first. Global finance lease revenue in 2021. It was just shy of $195 billion.
Right. A pretty hefty number to start with.
But get this. It's projected to climb to nearly $240 billion by 2025.
hmm
And then really accelerate to over $361 billion by 2033.
Wow. That's serious expansion.
It really is. It points to a major shift in how companies are thinking about finance globally.
Absolutely. And to give that some context, that growth works out to a compound annual growth rate, a CGR, of over 5.2%, 5.273% actually.
Okay.
And that's sustained over more than a decade. So this isn't just like a blip. It's a sign that leasing models are being adopted much more strategically in developed countries and emerging economies.
Now, what's driving it? Why this big shift?
Well, the report points to a few key things. First, just a general global increase in capital investments. Businesses are spending. Second, there's a real rising demand for flexibility in how assets are financed. Companies want options.
Right, they don't want to tie up all their cash.
Precisely. And third, the need for alternative funding mechanisms, beyond traditional bank loans across all sorts of industries. Think about it in today's economy: speed, adaptability, preserving cash flow. They're vital. That's why this matters, whether you're deep in business strategy or just interested in these major economic currents.
Okay, this is where I think it gets really fascinating when we start looking at the regions. Which parts of the world are leading this? And maybe more importantly, where's the most kind of explosive growth happening?
Let's start with Asia Pacific. The report is crystal clear.
Yeah.
This is the fastest growing region on the planet for finance leases.
Okay.
Its market was around $58 billion back in 2021.
Right.
But it's projected to more than double, hitting over $117 billion by 2033. That's a CAGR of over 6%.
Doubling. Wow.
Yeah. And this isn't just sheer economic size, though that's part of it with China and India. It's often linked to huge infrastructure projects, growing middle classes boosting demand, and companies deliberately choosing leasing to keep capital free for, say, innovation.
Let's zoom in there. China, you mentioned. How's it looking?
China's set to more than double its market as well. It's about $17 billion in 21, projected to hit over $35 billion by 2033. That's a strong CAGR, just over 6.2%.
Okay, strong indeed. But India, you said that stands out.
Oh, absolutely. India shows, tremendous potential. The projection is from about $9.2 billion up to over $20 billion by 2033. And its growth rate, it's the highest TAGR in the entire report, almost 6.8% annually.
6.8%. That's really flying. Signals major changes happening there.
Exactly. And it's not just the giants driving it either. Singapore, for example, shows really robust growth, nearly doubling its market size, about a 6.4% CAGR. And Southeast Asia as a whole, growing fast too, over 6.6% annually.
So these hubs are really powering that regional expansion.
They really are. It signals a significant shift in global economic gravity.
Okay, so that's the dynamic picture in Asia. Let's pivot now to North America. A more mature market, obviously, but still showing big numbers and steady growth, right?
That's right. A different pace, perhaps, but still very significant. The region generated about $62 billion in 2021, and it's projected to reach over $108 billion by 2033. That's a solid CAGR of just under 4.75%, so 4.735%.
Still substantial growth on a big base.
Definitely. And within North America, no surprise, the U.S. is the heavyweight. Its market share is huge, expected to grow from about $51 billion to nearly $88 billion by 2033. That's a CAGR of just over 4.6%.
Okay.
Interestingly, though, Canada, while obviously a smaller market overall, It actually shows a slightly higher individual growth rate, projected at around 5.5% annually.
Huh, interesting nuance there. Okay, so from North America's scale, let's cross over to Europe. Another mature market, you said, showing steady but maybe more varied growth.
Yeah, varied's a good word. Overall, Europe totaled just over $43 billion in 2021, expected to reach over $75.5 billion by 2033. The overall CAGR is around 4.8%. Pretty
Yeah,
steady
and within
number.
Europe, any standouts?
Well, Germany continues to be a real powerhouse. Its finance lease market is growing strongly, from about $8.6 billion to over $16 billion by 2033. That's maintaining a strong TAGR of over 5.5%, likely driven by its big industrial sector needing equipment.
Makes sense.
But yeah, Europe is diverse. The UK and Spain, they also show healthy growth, around 5.1, 5.2% annually. But then you look at, say, Russia, and its market's growing more modestly, around 3.4% CGR.
Right. So what explains those differences within the continent? Different economic factors, regulations maybe?
Could be a mix. The report hints at things like, Germany's industrial base naturally favoring leasing, whereas maybe Russia's navigating different economic cycles or relies more heavily on traditional bank loans for assets, which could slow down the leasing growth a bit.
Yeah, the wider economic climate always plays a role, doesn't it?
Always, definitely.
Okay, moving on. South America, you mentioned things are picking up steam there.
They certainly are, showing good momentum. The region's projected to grow from roughly $12.7 billion in 2021 to over $24 billion by 2033. That's a healthy annual growth rate, 5.5%.
And who's leading the charge there?
Brazil takes the lead in market size, growing from about $5.2 billion to nearly $10 billion, a TAGR just over 5.4%. But actually, it's worth noting Argentina, it's accelerating even faster. Its CAGR is over 6.2%.
Oh, interesting.
Yeah, projected to more than double its market size. And often you see this kind of growth linked to big infrastructure pushes or business development driving that need for flexible financing.
Right. What about the Middle East? Also showing promise.
Yes, definitely significant promise. The region logged about $10.7 billion in 2021 and is projected to hit just over $20 billion by 2033. That's an overall CAGR of 5.4%.
Any specific countries driving that?
The UAE really stands out. It shows quite impressive growth. Market size is expected to double, from about $2 billion to over $4 billion.
Yep.
That's a CAGR over 6%.
Oh.
And Turkey is also projecting strong growth, nearly 5.8% annually. If you connect that to the bigger picture, it really suggests a strategic push for, economic diversification and major investment across the region.
Makes sense. Okay, last but definitely not least, Africa. You mentioned a smaller base, but steady performance and untapped potential.
Exactly. Steady performance, significant potential. The region totaled just under $8.4 billion in 2021. It's set to rise to nearly $15.8 billion by 2033. So that's an annual growth rate approaching 5%, about 4.9%.
And within Africa?
South Africa leads the pack in terms of contribution. Its market's projected to double, from about $3.4 billion to nearly $6.9 billion. That's a CAGR over 5.5%.
Okay.
Nigeria is also showing steady growth from about $1.4 billion up to nearly $2.8 billion, which is over 5.1% annually. It's a clear sign, really, of growing economic activity and that increasing need for capital-efficient ways to get assets across the continent.
So let's pull all this together. What does it all mean for you listening and for the global economy? It seems crystal clear that the global finance lease market isn't just healthy, it's booming and it's changing fast.
It really is. And what's fascinating is seeing how those core drivers we talked about, the capital investment, the need for flexibility, alternative funding, how they're playing out differently in each region. Every area is contributing in its own way based on its economic needs and where it is in its growth cycle. It paints a picture of a really dynamic global market.
Yeah, not just one monolithic trend.
Not at all.
Yeah.
And as the source itself wraps up, you've got Asia Pacific really setting the pace for growth.
Yeah.
But you also have Africa, Latin America, the Middle East, rapidly emerging as really significant players. So the whole landscape for finance leasing is just becoming much more diverse, more resilient. It's not just a tool for established markets anymore.
No, it's truly global now. It's democratizing access to vital assets in a way.
That's a great way to put it.
So this deep dive really shows the market isn't just getting bigger, it's transforming. New leaders are stepping up, established areas keep expanding. It's like a quiet revolution in business finance.
Absolutely. Which leads to a really interesting thought to leave everyone with. Given this huge global move towards more flexible financing, like leasing, and seeing this incredible growth, particularly in emerging economies, how might the old ways, The traditional models of just owning assets, how might they evolve in the years ahead? What does this all mean for how businesses, large and small, will operate and grow and innovate in the future, perhaps without being so tied down by huge upfront capital costs?
Okay, let's unpack this. Today we're doing a deep dive into the global finance lease market. It's pretty dynamic right now. Our mission to
Yeah.
really explore the key drivers, yeah, but also the restraints, the things holding it back, and maybe most importantly, the emerging trends shaping how companies get their hands on crucial capital assets. So whether you're, a business leader looking for an edge and investor tracking shifts, or maybe you're just curious about how these financial models are changing, well, this dive should give you a really solid look at what's redefining capital acquisition.
Yeah, and what's fascinating here is just how much these models have moved beyond simply, buying something outright. Finance leasing isn't just some alternative anymore. For a lot of businesses, it's actually become quite strategic. It reflects a pretty big shift in how companies manage resources, how they handle risk, and how they plan ahead.
Strategic imperative. I like that. So, okay, let's start with what's pushing this market forward, the drivers. One of the really big ones seems to be this growing demand for capital equipment, especially in industries that use a ton of assets. Construction, transport, manufacturing. They all rely heavily on expensive machinery. It's obvious they need the gear. But why is leasing often like the smarter play here compared to just buying? How does it really change things for them operationally?
Well, the fundamental appeal really is that finance leasing lets these companies get that essential equipment, the expensive stuff, without needing a massive upfront investment. And that's critical because it preserves their working capital, keeps cash free, which means they can use it for other operations or maybe even make bold moves when the economy is a bit shaky, something buying outright wouldn't easily allow. So it's really about keeping operations running smoothly, staying agile. Leasing becomes a really cost-effective and strategic tool in that sense.
Right, preserving working capital. That liquidity benefit is immediately clear. But thinking beyond just the day-to-day cash, how does leasing specifically boost a company's sort of overall financial strategy? We often hear about this preference for off-balance sheet financing. What did that actually mean for the books, and why was that so attractive for companies wanting flexibility?
Yeah, so if we connect this to the bigger picture, corporate financial health, historically, the big draw of certain leases was keeping those obligations off the main balance sheet. So think of it like this. You lease a big piece of equipment, but it didn't necessarily show up as debt impacting your key financial ratios, like debt to equity. This helped companies look, well, leaner on paper compared to taking out a loan for the same asset. It could
Yeah.
improve those ratios, potentially expand borrowing capacity for other things. It offered a lot of financial flexibility and helped avoid those huge capital outlays that can really strain the balance sheet.
Okay, that makes sense. A leaner look, more borrowing power. Compelling stuff. But what about the other benefits, like tax and accounting? How do those sweeten the deal?
Ah, right. This is where it often gets really interesting, especially for the finance folks. Lease payments quite often qualify for tax deductions, so that reduces taxable income. And in some situations, the company leasing the asset, the lessee, can also take advantage of depreciation benefits. Plus, the payment structure is usually fixed and predictable. That helps a lot with financial planning and budgeting. Now things have changed a bit with modern accounting standards like IFRS 16 and the US version ASC 842. These rules came in fairly recently, and, well, they basically put most leases onto the balance sheet now. So much for hiding it. But even with that, the predictability of payments still helps with planning, and the standards aim for more transparency overall.
Okay, so those drivers paint a strong picture, but no market's perfect. There are always challenges. What about the hurdles or maybe the hidden catches in finance leasing? Let's start with that regulatory compliance you just mentioned. How have these new rules, IFRS 16 and ASC 842, really changed the game for companies that liked that old off-balance sheet approach?
Yeah, it's a really important question, how companies are adapting. Like I said, IFRS 16 and ASC 842 basically ended the party for traditional off-balance sheet operating leases for most long-term assets. Before, lease payments were often just treated as an operating expense, like paying rent, didn't hit the balance sheet as debt. Now, the rules say, nope, most leases create an asset, the right to use the equipment, and a liability, the obligation to pay. Both have to go on the balance sheet. Think of it maybe like renting versus a mortgage. Rent doesn't usually show as a huge debt on your personal books, but a mortgage definitely does.
Yeah.
These rules push leases more toward the mortgage view, and This might deter some companies, yeah, especially those who really relied on that off-book reporting to, manage how investors saw their debt levels. It changes the look of their financial health.
That is a pretty fundamental shift in how things look on paper. And speaking of costs,
Okay.
okay, upfront costs are lower with a lease, sure, but there's this worry about the total cost over time. Can a lease actually end up costing more in the long run than just buying the asset? What makes that happen?
Oh, absolutely it can. Yes. While you save upfront, over the full lease term, you might well pay more than the asset's original price tag. This often happens if you don't pay close attention to the details, things like the embedded interest rates, any maintenance fees rolled in, especially those end-of-lease clauses. What happens at the end? Is there a big residual value payment? Are there penalties for wear and tear? If you're not careful managing all that, the total cash outflow can definitely exceed buying it outright. It's a valid concern about long-term cost efficiency.
Right, got to read the fine print. Okay, and one last restraint, but it feels like a big one, especially for innovative companies. Asset ownership limits. What are the real downsides of not actually owning the asset during the lease? You mentioned agility before. Like, for a tech company needing the latest kit, this seems like it could be a major roadblock, right?
Exactly. That's a perfect way to put it. Since the leasing company, the lessor, still technically owns the asset, the user, the lessee, can face restrictions. They might not be allowed to modify the equipment, or maybe they can't sublease it to someone else if their needs change. Reselling it is usually out of the question, too. And that lack of flexibility, that lack of full control can be really limiting, especially, as you said, for industries that need to upgrade constantly or adapt technology really quickly. Having the ability to customize or even just deciding when to get rid of something, that's often crucial. So, yeah, you trade some control for that initial financial flexibility.
That trade-off is key. Okay, let's shift gears now. Enough doom and gloom. Let's talk about the exciting stuff, the new developments. One trend that seems really transformative is the rise of these digital leasing platforms. How is fintech actually changing the leasing game here, making it easier?
Oh, they're definitely game changers. These platforms bring um, a level of transparency and efficiency that just wasn't there before. Imagine doing real-time risk assessment, getting automated reports, managing the whole contract lifecycle, all in one place. Means faster approvals, way less paperwork, just a smoother process overall for everyone involved. And importantly, they often have compliance baked in, making it easier to handle those complex regulations we were just talking about. It's really streamlining how leases are sourced, managed, the whole 9 yards.
Wow, efficiency and compliance together, that's huge. And there's another trend that seems to be linking finance with bigger global issues. These sustainability-linked leasing models. We hear ESG everywhere now. So what does this actually mean for businesses trying to be greener? Are there real benefits?
ESG, environmental, social, governance criteria are becoming much more central to financial strategy. It's not just a nice to have anymore. Businesses are actively looking at their carbon footprint, social impact, governance structures. And finance leases are becoming a tool for this. Think about a company leasing a fleet of electric vehicles instead of petrol cars, or maybe a factory leasing energy-efficient machinery. These aren't just niche examples anymore. This approach helps companies hit their sustainability targets, which is good for the planet, obviously, but it also appeals strongly to investors who focus on ESG performance. And beyond that, you can sometimes see real operational savings, like lower energy bills, plus it can help attract talent and customers who care about these things.
That makes a lot of sense. Good for the planet, good for the balance sheet, potentially. Okay, wrapping up the trends. What about customization? Businesses always want things tailored, right? We're seeing more flexible, sort of hybrid lease structures. How are leasing providers getting creative here to meet specific needs?
Right, the one-size-fits-all approach just doesn't cut anymore. Businesses have really specific, often changing needs. So leasing providers are responding with more innovative hybrid models. These can blend elements of traditional finance leases and operating leases. What that means is you might get flexible usage terms, say, paying less during slow seasons, or having the option to scale equipment up or down easily. You might also see built-in options to upgrade the tech mid-lease, or clearer, more favorable terms for buying the asset at the end if you decide you want to keep it. It's all about helping businesses match their leasing strategy much more closely to their actual operational needs and financial goals. It's getting much more tailored.
Wow. Okay, so it's really clear the finance lease market is, well, it's moving fast. You've got this drive for capital efficiency pulling it one way, digital innovation speeding everything up, regulations reshaping the landscape, and now sustainability adding a whole new layer. There are definitely challenges, those restraints we talked about, but The opportunities for leases that are specifically tailored, smart on tax, and even align with ESG goals, they seem bigger than ever. It really highlights how much is changing in this area of finance.
Absolutely. And that interplay, between the drivers, the restraints, the new trends, it's definitely going to force businesses to think hard, to strategically reevaluate how they acquire assets and manage capital in the next few years. Kind of makes you wonder, doesn't it, as tech keeps accelerating and sustainability becomes, well, table stakes. Are we going to see an even bigger shift away from owning things towards more of an adaptive service-based approach to using assets? How might those kinds of shifts play out in your own industry or affect the financial choices you might make down the line? Something to think about.